Back at it again. What's up, y'all? Welcome to episode 3 of Whiteboard Wednesdays. Today, we're going over understanding assets. To build a strong portfolio, you need to understand different types of assets so you know what to put in your portfolio and when. So today, our agenda, we're going to be going over what actually gives an asset its value. Then we're going to go over different types of assets and then their use cases, when they fit into your portfolio, what type of investments you should want in your portfolio, and how they all flow together. So without further ado, let's get into it. Starting off, what gives an asset its value? There are 4 main drivers that give an asset value, and we're about to go through all 4, right? So those 4 drivers are first up, we have scarcity. We have demand. Usability. And we have cash generation. All right. Now, why are these the main drivers of assets, right? Let's start with scarcity. Scarcity, anything that you can't get in a high quantity will always have more value. Think of a Birkin bag as always the easiest example I give. Birkin bags are so popular because everybody can't have one, right? They're very limited. The more limited they are, the higher the value, and the more exclusive they are, meaning that more people want them, right? And that flows into number 2, demand. When something is highly wanted by people, that increases the price. Think of, say, a pair of Dunks, right? Or let's talk about some Travis Scott ones, right? Travis Scott ones only cost maybe $50 to $100 to make, right? But because they were so popular when they first released, they might retail for $200, but resale, they're going for over $1,000 because everybody wants them and they're in such limited quantity, scarcity. Then we have number 3, usability. If you can use something to for a wide range of use cases, then that also increases its value. Usability is very important for an asset because it has to have some kind of use case, right? And then last but not least, we have cash generation. If you own something that generates additional cash and generates additional income for you, that asset will have value. So we're going to be going into a couple examples of these 4 use cases and these 4 main drivers of assets. And to start off, let's use an apartment building. So example 1, apartment building. Now, an apartment building checks 3 of these boxes. So an apartment building has scarcity, usability, and cash generation. All right. Now, how does it check all 3 of these boxes, right? So first off, scarcity. There is a limited number of apartment buildings. If there weren't, then there wouldn't be homeless people, right? There should be more apartment buildings, but for whatever reason, there's red tape in terms of creating them. There's a limited amount of land that can be used to build apartment buildings. So they are scarce, and by being scarce, they have more value, especially depending on where it is. If you're in an area that doesn't have a lot of apartment buildings, that makes it even more valuable, right? So that's scarcity. Second is usability. Everybody needs a home. Everybody needs a roof over their head. So it provides value to the consumers, the people that purchase rent and pay rent to be able to live there. They need somewhere that they can lay their head at night, that they can, cook food, that they can have a bed, that they can shower and so forth. So apartment buildings has usability. And lastly, they have cash generation. If you own an apartment building, the people that pay rent to the building, that's income for you. So it generates cash flow without you having to do anything. As long as you keep up with the building, as long as you make sure the amenities are intact and that people live comfortably, they pay you rent, which generates extra income for you without you actually having to clock in and earn money. So an apartment building checks 3 of those 4, right? Let's use another example. Example 2, we have Apple stock, right? All right, Apple stock. Apple stock also checks 3 of these boxes. It has scarcity, demand, and cash generation. Just in a different way, and I'll get into that in a second. All right. First off, scarcity, right? There are a limited number of Apple shares. Now, technically, Apple can add shares to the market anytime it wants, but it's rare that it does that. So there are a few million shares of Apple outstanding, right? That means there are a few million shares of Apple that are available to be bought and sold, right? And technically, Apple can add more. That would be called a stock split. So it keeps the same value of the company, but you lower the price and increase the number of shares. Now, it's very rare for a company to do that. I think Apple has had 2 splits in its time. I could be wrong, 2 or 3, right? But they rarely do that because it dilutes the amount of shares that some other investors have. So they rarely do that. They want to keep and also, it costs money to do a stock split and add more shares to the market, even though they have the same value. So your investment is still worth the same amount of money, but that costs time and money for Apple to do that. So it's rare that they will add additional shares to the market. Demand. As long as Apple exists and as long as people are buying iPhones, people will want to own a piece of it, right? So Apple stock has demand. And then last but not least, cash generation. Now, owning Apple stock does generate cash for the owner through dividends, right? So the more shares you have, the higher dividend payments you get each quarter. But also, Apple as a business, the underlying company behind Apple stock generates cash. Apple generates billions of dollars in cash every single year. As long as Apple continues to sell iPhones, as long as people want to buy them, and as long as that cash keeps coming into the business, the stock itself will always have value, right? And then that takes into example number 3, which is Bitcoin. And Bitcoin also checks 3 of these boxes. So we have scarcity, we have demand, and we have usability. All right, now scarcity. How is Bitcoin scarce? Bitcoin is the first and the only real digital commodity. What I mean by that is it is essentially more closely related to gold than any other asset that exists, right? But digitally. So scarcity, there can only ever be 21 million Bitcoins, period, right? Bitcoin has to be mined digitally just like gold does, except with computers. So you have people that have warehouses full of data centers that they use to solve these complex math equations to mine Bitcoin. But there can only be 21 million Bitcoin to be mined. Once we hit 21 million, there will be no more. So once all the Bitcoin is mined, they're just out in a while, and whoever owns them just keeps them unless they want to sell them, right? So scarcity. Then that creates demand because there can only ever be 21 million Bitcoin. It increases the demand to want to own Bitcoin, right? You want to have a piece of something that does not have an unlimited amount, right? Just like gold, right? Once all the gold in the world is mined, you can't make any more. People have been trying to make gold for hundreds of years. We haven't figured it out yet. Maybe one day we will, but until then, gold will always have value because there is a limited quantity of it. Same thing applies to Bitcoin. And then lastly, usability. Bitcoin is the only real cryptocurrency. There are other crypto coins, but they're not necessarily cryptocurrency. Now, you can say stable coins are also cryptocurrency, but Bitcoin is the real cryptocurrency because it can be spent like dollars. You can spend Bitcoin at the grocery store. You can use Bitcoin to purchase a house. You can spend Bitcoin to order an Uber. Bitcoin became popular because in 2009, somebody bought 2 Papa John's pizzas with Bitcoin. That Bitcoin is now worth over $1 billion that he used to purchase those pizzas. So it just speaks to how these three factors increase the value of Bitcoin over time. And the more Bitcoin is mined, the less that becomes available to be purchased, the more it will increase in value. And also is why people want it, because dollars, as in cash, have an unlimited quantity, which I'll touch on in a second. But Bitcoin checks all 3 of these boxes, right? So now we're going to get into different types of assets, kind of give a brief explanation of them, and also what they're to be used for. And starting off, we're going to kick it off with the almighty dollar, cash. All right, cash, money. What is cash? Cash is the most liquid asset. You earn cash by selling a product, selling a service, clocking in with a job, going to work, et cetera, right? There are a bunch of different ways to earn cash. Cash can be used to purchase other items as well as other assets, right? So cash is not a storage of wealth. Let me say that again. Cash is not a storage of wealth. That's because of inflation. Because cash has an unlimited quantity, meaning the government can print as many dollars as they want. That's called quantitative easing. I've touched on that in some previous videos. But because there is an unlimited amount of cash, it loses its value every single year because they keep making more of it. So it is not a storage of wealth. If you take a bunch of cash, stuff it under your mattress, and don't touch it for 10 years, you will not be able to buy the same amount of stuff as you were able to 10 years ago, right? So just to give you an example, let's say you win a lottery, right? You win $100,000, right? $100,000 today could probably get you a down payment on a house, right? Because let's say you get a $400,000 house, that $100,000 could be used for a down payment. Instead of buying a house, if you stuff it under a mattress and don't touch it for 10 years, that $100,000 might not even be able to get you a down payment on a house anymore because the house will become more expensive. You usually have to put down 20% to a house, 10 to 20%. If that 20% stays the same and the house goes up to $750,000, that $100,000 is no longer your down payment amount. So cash is not a storage of value. What is it used for, right? So first, I'm going to say, what is it not used for? Not a storage of value. Please keep this in mind. Cash is not an asset of value alone. But what is it used for? Used to purchase goods, services, and assets. Make that a little bit more clear for y'all. Cash is just a vehicle to purchase assets that actually have value. Please never forget that. So if you see somebody flexing with a stack of cash, they showing that they got X amount of $1,000 in their bank account. They not flexing for real. It's not the flex they think it is, right? Cash is just used to purchase goods, services, and other assets, right? So when you make money from your job, right, don't just keep it in your bank account. Keep a portion saved aside so that way you do have money to purchase things, but also put it into assets like stocks, ETFs, even real estate eventually, right? Bitcoin, cryptocurrency, so forth, right? Things that have one of the four values that we talked about earlier: scarcity, demand, usability, and cash generation. Cash only has usability. It's not scarce because it can make an unlimited amount. It doesn't have demand except for the fact that you can use it to purchase things. It doesn't have cash generation either. Cash just sitting there does not earn you a lot of money. At most, you can earn maybe 4% from a high yield savings account. But cash itself does not have any value, right? So let's go into the next one. Next, we have stocks. My personal favorite. Now, stocks are a piece of ownership in another company, right? So if you own Apple stock, you have a piece of ownership in Apple as a company. If you own Amazon stock, you have a piece of ownership in Amazon as a company. If you own Uber stock, you are a partial owner in Uber. So if you believe that a company will stay in business and will continue to earn money, then owning the stock means that as the company appreciates, the amount that you invest in that stock will also appreciate, right? So what are stocks used for, right? Well, first, stocks are not used for selling for quick cash, right? Unless, I'll hold on that for a second. Not used for quick cash, right? To really get the value from stocks, you want to hold for a long period of time, at least 5 years, that allows your money to compound over time using compound interest. The longer you hold a good quality asset, the more your money will make money over time. So just to give you an example, right? If you have $1,000, let's say you earn 10% on that $1,000 per year, right? After year one, you'll earn 10% on that $1,000. That would be, let me write this out for y'all. Let's say you have $1,000, right? And it goes up by 10% per year, right? So after this is horrible. After year one, that would be $1,100, right? Then after year two, this would earn 10%. So instead of having 1,000 earning 10%, now you have 1,100 earning 10%. Year two, you would have, what is that? $1,210. And then this $1,210 will earn 10%. So this is what's called compound interest, right? So stocks are not used for quick cash. What they are used for used to build wealth over time. Now, one other use case, if you are interested in becoming a more advanced investor, is trading. Stocks can also be used to generate cash flow through trading. Now, if you're just getting started, I don't want you to worry about trading. I just want you to worry about building up your portfolio. But I do want to touch on that just because stocks can be used to generate additional income through trading, right? So let's go on to the next asset. Let's go into, I'll touch on this really quickly. I personally don't think people should invest in them anymore, and I'll explain why in a second. But I'll quickly touch on bonds just so you can understand what they are. Bonds are loans to the government in exchange for income. There are also bonds to companies, right? So let's just say loans to someone or something okay, that's not good. Hopefully my board doesn't fall, but let's ignore it for now. In exchange for income. So typically the most popular bonds are U.S. government bonds, right? The most popular is the 10-year. Let's say the government says they need some money, right? You might say, I'll give you $5,000, and in return, you give me 4% interest per year. And at the end of that 10 years, you will have interest that you accrued over that year, and you'll get your $5,000 back. So you get income every year for loaning them your money. You can do the same with companies. Why do I not like bonds? Because the U.S. government has $38 trillion in debt. The more debt they run up, the less valuable bonds will be. And eventually that money in the U.S. government that the government owes will come due. And when it does, your bonds will be worthless. Bonds are backed by the faith and credit of the U.S. government, but I do not trust an entity that has $38 trillion in debt. So just want to put that out there, right? Let's go into, I'll kind of pull both of these together. Let's do index funds and ETFs, right? So an index fund is a pooled investment vehicle that tracks a stock index. So typically that would be, the S&P 500, the NASDAQ, or the Dow Jones, right? So index funds move in tandem with any one of these indexes. And some index funds that go with these are, for S&P 500, you have SPY. For the NASDAQ, you have QQQ. And for Dow Jones, you have DJI. So these are index funds, right? If you want to invest in the entire S&P 500, you can invest in SPY. If you want to invest in the entire NASDAQ, which is mostly tech stocks, you can invest in QQQ. And if you wanted to invest in the Dow Jones, you can invest in the DJI, right? Now, how do ETFs differ? Technically, they don't, but ETFs are a little bit more flexible. ETFs, which stands for exchange traded fund. So an ETF stands for exchange traded fund. This allows you to invest in multiple stocks at once, right? So if you don't feel comfortable picking individual stocks yourself for your portfolio, you can invest in an ETF to give you multiple companies at once. And they have ETFs for everything. So technically an index fund is an ETF, right? You also have ETFs for strictly tech stocks. You have ETFs for semiconductor companies. You have ETFs for utility companies, healthcare companies, consumer discretionary, which is things like Amazon, Walmart, Nike, Lululemon, stuff like that. Consumer staples, that would be Costco, also Walmart. What else is a consumer staple? Consumer staples are companies that are always needed, especially in times of a recession, right? You will never stop shopping at Costco just because there's a recession, right? Because you always need goods, essentially. So there is an ETF for just about anything. ETFs are great if you want to invest in multiple companies at once without the hassle of having to put money in each one of them, right? This is the easiest way to build wealth for anybody, right? The S&P 500 has increased by 10% per year each year for the past 100 years, right? So over time, ETFs will give you more value on your money than any bank account ever can, right? So this is the easiest way to invest in the stock market, right? So what is it for? Just like stocks. So not used for quick cash, used to build wealth over time, right? That's a little ugly, but y'all get what I'm saying. Used to build wealth over time. Just like stocks, you want to hold these for a long period of time. Like I said, the S&P 500 has increased by 10% per year on average for the past 100 years. And there will be years where you do even better than that. For the past 5 years, the S&P 500 is up 100%. So that's a 20% annual return over the past 5 years, because the S&P 500 swaps out the weak companies and puts in the strong companies. So if there's a company doing well, it goes into the S&P 500, which if they do well, the entire index does well, which means your money does well as well. So index funds and ETFs are the greatest ways to build wealth. Let's see. All right, I'll do the next one really quickly just because I want to touch on it. Next, we have commodities. Not as common for investing, but I do want to touch on one. Commodities are your rare earth metals, think gold, silver, copper, right? Food is also considered a commodity. So you have soybeans, coffee beans, wheat is a commodity. So anything that is used can be traded, right? Technically, you can invest in the value and trade the value of coffee beans, right? You can invest in and trade the value of gold or silver, right? Now, the only one I will mention that's a good investment to hold is gold. So I mentioned earlier that gold is a limited quantity asset. Once all the gold in the world is mined, there will be no more, right? So gold can be invested in through an ETF, which is called, let me make this a little bit more clear for y'all. It's called GLD. It is worth considering having gold in any portfolio because as long as they keep printing money and they cannot create more gold, gold will always increase in value. In fact, over time, gold itself has actually outperformed the stock market for the past few years, right? Especially this year. Gold is up 50% this year, more than almost any stock. Not all of them, but almost any stock. Most stocks on the S&P 500, right? Gold will always increase in value as long as they keep printing money, and they will keep printing money. So I just want to put that out there, right? And then last but not least, we got crypto. And I want to really break this down because there are a lot of scams in crypto, right? What is crypto? Crypto means a digital asset. That means Bitcoin, and there are a wide range of others. Now, I mentioned that Bitcoin is the only real, legitimate, original cryptocurrency, right? Bitcoin was the first, and then everything else is a carbon copy to recreate that. But what makes Bitcoin so unique is that, like I said, there can only ever be 21 million, meaning nobody can ever make any more, right? At least they haven't figured it out yet. All the other crypto coins aren't tied to anything particularly of value, but they do have value in other use cases, right? So think of Ethereum as another one. So just to give you some examples. So you have Bitcoin, right? The original. You have Ethereum. Ethereum, unlike Bitcoin, does not have a limited amount, but Ethereum is used as a highway for other crypto transactions, right? So I'm sure you may have heard of stable coins. Banks and stuff are creating their own stable coins on Ethereum's network. And all payments that are transacted through their network, they earn fees, meaning the more income Ethereum earns, the more the crypto coin goes up in value. So Ethereum does have value. Let's see. Payment network. And then you have something like XRP is another one. Also a payment network. But crypto in itself is just a digital asset, but they are not all used as currencies, right? So you can't really go to a store and spend Ethereum, right? It's more of storage of value. Technically, you can go and spend XRP, but most people won't. It has to be accepted somewhere. Bitcoin is accepted all around the world, right? You could send a Bitcoin to Africa if you wanted to buy something from Africa. You could send a Bitcoin over to Europe if you wanted to buy something. The others, the thing that gives crypto value is that it's not tied to a payment network like Visa, right? So when you spend dollars, when you swipe your debit card, it has to go from, let me visualize this for y'all. Let's say if you wanted to buy a, I don't know, let's say you wanted to buy a loaf of bread from the bank, right? From the grocery store. So that money has to go from your bank to Visa's network to the grocery store and then you get your item. But Visa charges fees, usually 2 to 3%. So grocery stores increase the prices that you have to pay because they have to pay Visa first. But crypto, instead of going through Visa, crypto goes from your wallet straight to the grocery store. So I'm gonna just bring this down here just so you can see. So you cut out the middleman. That's why crypto is so popular and Bitcoin has so much value, because it cuts out the middleman, right? So that was a lot, but that pretty much covers all major assets. Understanding the assets that you have in your portfolio is critical so that, one, you can build a diversified portfolio, but also so that if something happens, you know that you can understand the cause and effect relationships and how things that happen to one asset affect another. Because as I said, the more they print cash, the more stocks and Bitcoin go up in value. The more they print cash, the more gold goes up in value, and vice versa. So you have to understand what goes into each asset and how they all have a cause and effect relationship with each other. But this concludes episode 3 of Whiteboard Wednesdays. Stay informed and stay invested. I'm going to catch y'all next time. Peace.